The views and opinions of this program are those of the host, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading.
For over 95 years, we've set the bar. Power, we restored it. Protection, we reinvented it. Record yields, we redefined it. If there's one thing we know at FS, it's that just because something hasn't been done, doesn't mean it can't be done. We're never satisfied unless we take your farming operation to the next level. Run your equipment at peak efficiency and bust the bins this season. Visit fssystem.com.
Well, it has been quite an interesting week in the market trade overall. Thursday, wheat was the leader with corn quietly unchanged for the most part. Soybeans under a little bit of pressure. Cattle, hogs, mixed bag in the cattle market with hogs a bit higher as well on the day Thursday. But there's a lot going on here to give us some common sense perspective to things. We welcome in our good friend Bryan Doherty, Senior Market Advisor at Total Farm Marketing, joining us here today. And Bryan, always good to have a conversation with you, my friend. I hope you're doing well.
Yes, sir, Jesse. Always good. I'm doing well. Maybe a little better than the markets this week compared to last. Last week we started seeing a little momentum building to the top side. Prices peaked in corn and beans on Friday and quickly reversed on Friday and took what was a really stellar looking week to a not so great end of the week, and then a poor start this week with the markets down almost every day. And harvest pressure, a little rise in the dollar, technical selling broke through some support. All variables this week in the corn market back down toward the lower half of its range now, with December closing today 479.25, beans down 8 3/4, 1279.5. Bulls are a little bit disappointed, but I'd say, don't despair. This is kind of typical this time of year. We usually don't go straight up when you have bigger crop years. The other thing to keep in mind, too, is that farmers were very light sellers on new crop corn this year in particular. And this last rally, we saw December corn close at 505 last Thursday. So our first close above $5 at some time. 509. I think they probably pulled a few bushels out of farmers' hands. That was a good enough rally off the low of 467.
Yeah, great point there. Well, and you mentioned this last week. It was nice to see some volatility back. Well, here we go, a week later, and we're back down to levels that are essentially our lows here, and especially that core market. I want to talk about that a little bit more with you, as 480 has kind of been that level we've hung around for quite a while. But I know with this Dees contract breaking through some support levels and kind of opens us up again to the downside some more. Yet Thursday we were able to kind of just hold around 480 in Dees corn. So what's your thoughts? You look at a chart technically, I mean, what's it feel like the money flow and the momentum is here in this corn market right now?
I think the money flow went back short corn at the end of last week and then early part of this week. You broke some support levels. That is, you broke the 21, 40, 50-day moving average. That likely triggers some selling. But there's another line that was violated that really did not look healthy, and that was on Tuesday. So if you take the low on the contract, and that came on September 18, 460. What were we here? 467.75. I think I said 467 before, but 467.75. And then the market sort of this steady march upward. And so when you connect that low to other lows, you had this really nice, almost a 45-degree angle line that was pointing from the bottom to the right up, or from, let's say, 6 o'clock to 3 o'clock on a clock. And so you got this nice little, that's called a channel line. You got a nice channel line there. The market closed under that channel line and under moving averages. And I think that opened the floodgates to a lot of either longs, that is, people who bought exiting their long positions, or shorts being established, people starting by selling. But I also think the rally put grain into the pipeline to elevators. And so when an elevator buys the corn, they have a couple choices with it. They try and sell it to somebody else. They can store it and take the risk, which they're not usually in the business of doing. Or what they do is they, for lack of better visuals, pick up the phone, call the floor, and hedge it and sell it. So that's a sell order coming into the market. It's got to find a buyer. So when you get a lot of sell orders coming in at one time, it'll find buyers, but usually at lower levels. So that was the pressure, I think, from the farmer selling and technical weakness. The chart is holding, though, at what's called, one of the signals I like, they're called Bollinger Bands. The last 2 days it held at the lower Bollinger Band, where last week it challenged, slipped through the upper Bollinger Band, hit the 100-day moving average, and reversed down right back under the Bollinger Band. So it seems like it's stuck in a range, and that's really what the technicals tell us. Better support, or I should say, if we hold the Bollinger Band, and next support near that 467 and 3/4, that's a key area there.
Well, and I know too, export sales were good this week for corn and for soybeans. Soybean market was under a bit more pressure on the day Thursday. I know soybean meal has kind of been the catalyst of our recent rally in soybeans. We got another export sale announcement to China Thursday morning, yet here we are finishing down 7, 8, 9 cents in soybeans on Thursday. So what's your thoughts? You look at the charts and watch things in the soy complex. Let's talk about that a little bit more. What are your thoughts there, Bryan?
Yeah, so the thing in the soybean oil, let's start with that is in a really steady, and we talk about channel lines, real steady downward channel of prices since what I'm going to call a double topping with the last top back on August 21st. And steady downtrend. So that got that component of the complex weaker, and everybody's kind of scratching their head going, well, what about all those crushing plants and bioenergy and things, all this to meet? Well, that's still coming and down the road, but you got world vegetable oils that have been on the defensive. And so soybean oil, with the crush number moving up in the U.S., and we're not selling the oil as quickly, or the beans as quickly, down the market goes. So that component has been a dog. The meal has been the strength. Pushed into, and its highest price here 2 days ago since back in June. And in June, it peaked right at the same level that it peaked at in March, and then back in December of last year. So soybean meal kind of hitting that 425 area-ish and running out of gas, and currently trading around 416. That's been the strength. Why? Argentina, again, drought conditions, smaller crop. They're the biggest exporter of meal to the world. That has been hampered. The U.S. expected to pick up more meal because we've got the beans available. Brazil running short on exportable beans. Our export sales have picked up. Even with that said, I'm still disappointed in the bean complex because when you look at the southern hemisphere, maybe you got a little more scattered rain this week in northern Brazil, but the 15-day forecast that I can tell looks pretty doubtful for copious drought-breaking type rains. And with the world kind of having a strong appetite for Brazilian soybeans, to me, you've got a less than ideal weather market developing for the planting season. With plantings, remember, it started ahead of schedule this year, then falling behind schedule due to dry weather conditions. And then you get into southern Brazil, and they continually run into wet weather patterns. So big country, a lot of diversity, but not ideal.
A lot of things to keep our eye on here. And really, I think in the case of quarter beans, to your points earlier, might have seen some farmers selling here as we got corn over $5 towards the end of last week. But overall, with harvest pressure and more, watching things develop in South America, just feels like as farmers are wrapping up harvest, they need to really look at taking some of the risk off the table at, any time of year for that matter. But right now, feels like one of those time frames where they just need to kind of look at things, get out their pencil, sharpen it up a little bit, and make sure that their risk management is up to speed right now, Bryan.
Right. Here's one other thing we didn't mention in beans, though. So I'm looking sort of this fundamental supply picture: 220 million bushels of stocks here at home. Stocks usage, I think 5.6, historically very low, and kind of impatient that the market isn't moving. But I also think the farmers have filled the pipeline pretty strongly with bean sales. And as you've talked to farmers at harvest, they'd rather store corn than beans. They've been selling beans. They don't want to give up. We were north of $13 on beans here just days ago. So it's still a pretty good value. When you look at it, if you're holding beans, you got to ask yourself, well, how much can beans rally without a weather market? Maybe 50 cents, maybe $1. How much is it going to cost me to store beans with 8% interest on my loan versus I could sell the beans, grab 5% on a CD, and have the risk off my back and the money flow in my hand and the storage space open for corn. So I think there's some logic behind farmers who may have been thinking that way rather than just say, well, I guess I'll store beans and wait for a rally. So we'll see. Historically, the market does have a tendency to try and find a bottom into the fall. And there's some what we call seasonal patterns that, again, point to higher bean prices in recent years. We look at a 5, 15, 30 year. Most of those align to good recovery and strength in the bean market. So I think from a risk management perspective, we're not surprised if farmers, let's say, sold their beans, went right back on paper and bought some kind of a, let's say, a fixed risk call or call spread or something where they can still participate, but they know what the risk is to the upside. They know what the risk is to the downside. They've got it all covered. They know what their capabilities are. I think that makes a lot of sense if you want to sleep easy at night.
We're having a conversation today with Bryan Doherty with Total Farm Marketing. Bryan, wheat trade on Thursday was the upside leader, especially Chicago wheat. I know there's been some talk that the Ukraine humanitarian corridor might be shut down right now. So wondering that even in the face of a U.S. dollar working higher on Thursday, wheat was higher. Maybe it was partially due to the Ukraine situation, maybe a little premium there. What's your thoughts on the wheat markets overall?
I think today's activity was a direct correlation to that corridor being shut down. Now, the words I've read in a couple of different sources are temporary. So we'll have to see. But nonetheless, the market picked up on it. And so things must be getting a little edgy over there again. So and that's a concern. And that does maybe open the gate for some recovery here, or at least buyers thinking about buying from the U.S. Does it change the trajectory of the market all of a sudden to just really bullish? No, we've seen any of the war premiums. None of it has led to anything bullish. Russia still has a plethora of wheat or has wheat to sell and compete. They're offering it out. Countries are buying it. Wheat's just in a tough spot right here. It does look like the winter wheat here in the U.S., the first ratings will be Monday. It's expected 50% of the crop could be rated good to excellent in that window, Jesse. And if that's the case, that'll be the best rating in 4 years. So the bears out there are going to say, okay, you can rally some, but we're probably not going to let you rally a lot if ratings are good. And we're just not seeing anything else but a kind of a steady upgrade in the dollar.
Bryan, let's talk livestock here a little bit as well. Hogs had a pretty solid day Thursday, maybe trying to find some support and a bottom here, potentially in the hog market. Meantime, cattle, we obviously had that really rough day Monday coming out of that cattle on feed report. Since then, feels like cattle's maybe trying to stabilize here and find some support and find some demand at lower prices. What's your thoughts in the protein sector here this week?
Yeah, you're trying to break it down, and we've always cautioned that these high prices could really squash demand, but we're not too worried about the supply side. That being said, the cattle on feed report had a little bit of a negative tone with a higher placement number than expected. Marketing's higher or lower than expected, and then on feed actually higher than expected. So you kind of got the trifecta of all numbers working against the cattle, and that added fuel to an already weakening market. So that fire lit a little hotter, with prices capping lower on Monday. The market has taken quite a bit of premium out, and I think we're starting to get a footing here. And there's one other thing I want to look at, but if you look at like December live cattle futures back in mid-September, 192, here 180, 142 was the low. 2 days ago, Jess. That's a pretty good carve out. That's enough drop off that the market will probably find some consolidation. We're trading back to the same price levels that we saw back in June. But one of the things that we kind of want to keep an eye on here is this week's cold storage report. Basically what it said is that all beef and lockers took a bit of a jump higher, and it's at its highest level since May. So what is that signaling? Is that signaling that the consumer is finally saying, we're not going to, and I think it is. I think we've argued that consumers just keep spending money anyways, but I think they're being a little more selective. Everywhere the consumer turns, whatever you want to do, it costs more. and you want to fly somewhere, it costs a ton. Everything's expensive, so I think they're being a little careful there. Whereas the all pork in cold storage at the end of September actually showed a decline and at its lowest level for the calendar year. And
Mm-hmm.
you can't help but think that dichotomy is telling you something. There's less pork and more pork demand and less cattle demand, or less beef demand. It's trying to simplify it. That's what it's pointing to. And the market now has reflected that.
Bryan, how about the dairy trade? What's your thoughts there? Any notes for the dairy market this week?
Boy, strap on your seatbelt. You talk about kind of corn and beans going up strongly. Boy, milk did the same thing. Give you just a brief example on the December milk contract here. On the 5th of the month, 17.26. On the 19th of the month, 18.87. Nice pickup, nice shoot higher. Where are we today? The low, 17.16. That took out the low, and it's a new contract low today. So really volatile. I mean, you're talking big percentage changes in the value of a contract. $2 change in milk at $18 is significant. It's more than so you're seeing 10% swings within a week or two. Lots of volatility. I think it's erratic, and I don't really know why the market sold off as hard as it did. When you look at, like, for instance, I think it was GDP numbers out of China, if that's the right acronym. But anyway, the numbers out of China were showing that all areas of their economy seem to be picking up, with the exception of the real estate. And so you got to be thinking, the consumer is starting to spend some more money there. They've had stimulus packages in place for some time, starting to see the reaction to that. So in the news, when milk prices were higher, now they're lower. You kind of scratch your head. Well, what is the reason for lower? Cow numbers are down. Production is off. I'm not sure why the market is where it is. I want to believe, and we talked about this, I think, last week, that we thought milk was cheap, therefore cheese was cheap, that you'd see your end buyer buying hand over fist. And when the market went up, it made sense. I don't know why they wouldn't be buying hand over fist again. This is good value in front of their needs for holidays, Super Bowl, those areas. So the milk market seems to be undervalued to me. It's reaching into the oversold territory pretty quickly on stochastics. Likely an area where consolidation continues, but it was just disappointing again to see the upward momentum squashed down quickly. That's the third time that has happened since July, and the selling comes in pretty hot and heavy. So again, that maybe the bigger message is on all commodities. The marketplace is worried about recession and world recession. That's the takeaway, I guess I'm going to say this week.
Well, Bryan, I know if folks have questions, they could reach you easily by phone, email, the website. How could folks get in touch with you there at Total Farm Marketing?
Well, first, I'd like to say thank you for having me on the show again, and appreciate that. And we'd like to talk to you. 800-334-9779. Again, 800-334-9779, or Bryan with a Y at totalfarmmarketing.com. Shoot me an email or check out our website, totalfarmmarketing.com. A lot of great resources. Ideally, we'd like to hear from people and get their positive feedback, their constructive criticism, but listen to what your needs may be and make sure that we're trying to provide a solution to those needs.
Well, Bryan, it is always great to have you here on Market Talk. Thanks for contributing and joining me as always. Have a great weekend, and we will talk to you again next week.
Always my pleasure. Thank you, Jesse.
Bryan Doherty with Total Farm Marketing. That's going to do it for Market Talk today. Find us at markettalkag.com. I'm Jesse Allen. Have a great afternoon.